all about trusts. Now, don't switch this video off because you've heard the dreaded T word, trusts. I know many, including accountants and advisors, would run far away as possible from trusts. And the reason for this are many, but I would say it's because they are obviously not the most common structures, as in you have sole traders, partnerships, limited companies. Most people are familiar with these types of structures, right? But when it comes to trusts, they are, or they can get quite specific. And then you also have the specific terminology. The taxation rules relating to trusts are quite complex and complicated as well. So I will aim to demystify and explain as best as possible in layman terms the different aspects or angles that can be considered when it comes to trusts. Before we go on, don't forget to like, comment, share and subscribe to our channel. This video is brought to you by Aswat Tax, Chartered Tax Advisors. My name is Omar Aswat. So we have 4 episodes, very short videos. And in this first episode, we'll be explaining or trying to understand what is a trust in and of itself, why are they used, and the 3 main components or individuals of a trust, which is the settlor, trustees and beneficiaries. In future episodes, we'll look at the different types of trusts, discretionary trust being the most popular, and then separately we'll explain and outline the income tax and capital gains tax implications, and finally, and quite importantly, we will assess and explain and understand the relationship between inheritance tax and trusts. And we'll probably look at some sort of planning that can be explored as well in that final video. So what is a trust? Now, a trust, quite simply put, is a legal arrangement between settlor and the trustees. As I say, trusts can get quite complex and we can go into loads of detail, but that's not the aim of these videos. So a legal arrangement between a settlor or settlors and the trustees. And effectively, or in a one-line sentence, the trustees hold or legally own certain assets within the trust that were introduced by the settlor for the benefit of the beneficiaries. Okay? And these individuals involved and the terms of the trust are all outlined in a legal document called the trust deed. There are a number of reasons why people set up trusts. Traditionally, it was an extremely important vehicle or tool that was used for inheritance tax planning. However, since the introduction of new rules in 2006, you could say the tax benefits have slightly diminished. Although I would say, as in they've diminished, but they are still an important part of family and estate planning. Moreover, a trust can provide flexible financial protection for members of the family, and it basically allows for the transfer of generational wealth in a tax efficient manner. Now, there are other tools that can be explored. As I say, we assist our clients in a high-level inheritance tax planning. And one other method I would like to mention is the family investment company. And there are quite a few advantages or benefits of family investment companies these days over trusts, and FICs are approved by HMRC, by the way. But however, I would say that a blended sort of structure still plays an important part in effective tax planning. Moving on to the 3 components, so you could say that a trust is a relationship between 3 parties: the settlor, as mentioned, the trustees, and the beneficiary. We mentioned that one sentence: the settlor or the trustees hold and own the assets introduced by the settlor within the trust for the benefit of the beneficiaries. So we could say, therefore, that the settlor is the person or the individual or the individuals that introduces or puts money or settles money or assets into the trust. So listen to the terminology. The settlor is the one who settles assets into the trust. And when I say assets, it could be, for example, cash, property, shares, and other types of assets. Assets are normally introduced within a trust during lifetime, or they could be set up on death by way of a will. Quite commonly, trustees would be trusted family members or friends of the settlor, as in the settlor is not just going to appoint random trustees. It's usually a trusted family member or friend. And at times you can have professional advisors such as accountants and solicitors. They quite often are professional trustees within a trust as well. A trust can have a maximum of 4 trustees and a minimum, you could say 1, but ideally you have 2 trustees in place, because obviously if something happens to one, or if one dies, then the other trustee is still on hand to sort of continue the trust, continue to make the decisions. And in terms of the responsibilities of trustees, as I mentioned, the trustees are the legal owners. Okay, so the settlor does not own the asset anymore. The settlor, once the asset is transferred into the trust, it is outside the settlor's estate for IHT purposes. That's after 7 years. That's a separate rule. We'll look at that separately. But effectively, the legal title, the legal ownership of that asset, so we said cash, property, shares, for example, it belongs to the trust and managed by the trustees. So trustees are the legal owners of the assets, and in terms of what their obligations or responsibilities are, it would be to effectively deal with the assets according to the settlor's wishes. Now, those wishes could be by way of the trustee in and of itself, a will, or a letter of wishes. Other responsibilities for trustees include the management of day-to-day operations, as well as the ongoing tax obligations, such as the trust returns, R185s, and of course paying the correct amount of tax due to HMRC, as well as deciding how to invest or use the trust assets. For example, the cash, how is it going to be invested, for example. As I say, the trustees are the legal owners of the trust, so they do have a legal obligation to ensure the compliance is up to date as well. And so depending when you're watching this video, but from 1st September 2022, nearly all trusts and all non-UK trusts that own UK property will be required to register the trust under HMRC's Trust Registration Service. Last but not least, the beneficiary, and it says it in the name. The beneficiary or the beneficiaries are those who benefit from the assets held in the trust. So the trustees don't directly benefit. It's the beneficiaries that are named on the trust deed that benefit from the assets held in the trust. And the beneficiaries can be individuals, so Mr. X, Mrs. Y, for example, or spouse, or daughter, son. Or it can be classes of individuals, such as my children, or all of my grandchildren, or Mr. X's children, for example. And as I say, the beneficiaries benefit from the assets of the trust, and the way they benefit could be by way of income or capital or both, and that will be explained in a separate video. One more thing I'd just like to make comment on is that the settlor, so we said the settlor is the one who introduces the assets into the trust. The settlor can also be a beneficiary, but in that instance, it will be called or known as a settlor interested trust, and specific rules apply. And we'll look at settlor interested trusts in episode 2 of 4, which is the types of trusts. So I hope that was beneficial. I hope that was useful. We'll just say that one sentence again. The trustees are the legal owners of the assets introduced by the settlor into the trust for the benefit of the beneficiaries. Nice and simple. You've heard that sentence 3 times now, right? So you should be a master of trusts. Not really, but at least now, hopefully, you have some sort of understanding. Trusts, and especially taxation on trusts, are a complex and complicated area which we assist our clients with. So do get in touch. My email address is up above. I am a chartered tax advisor. I hope you found that beneficial. I hope you found that useful. Don't forget to like, comment, share and subscribe to our channel. Thank you for watching. Thank you for listening. I'll see you in episode 2.